Hey Scott, and I am live on Facebook and Bigger Pockets. I am here today to talk about, I don't know what I'm going to talk about, but we'll talk about stuff. And I'm going to take questions. If you have any questions, let's see. I'm happy to talk about real estate. I'm happy to talk about what's going on in the economy. I'm happy to talk about money and financial stuff. I'm happy to talk about investing. I'm happy to talk about businesses. We can talk about current events. Don't ask me about the coronavirus because I am not an epidemiologist and I know nothing about that sort of stuff. But when it comes to finance and investing, I'm here to take your questions. And so before I jump in and start talking about what's going on in the world and stuff, I am going to do a quick little plug for an awesome resource that is coming out from Bigger Pockets starting next month. This is really great. I've been wondering for years when they were going to do this, but Bigger Pockets finally got on board and is starting to release a physical magazine, a monthly magazine. And the first edition of the magazine, it's called Bigger Pockets Wealth. And the first edition of the magazine, I believe, is coming out next month. I don't know exactly when it's going to ship, but they're doing a very special discount on that. So it's 20% off. If you go to biggerpockets.com/store, you'll see a link for the Wealth magazine. On the cover of this month's magazine is a friend of mine named Joe Asamoah. Joe is an awesome investor up in Washington, D.C., and he's actually going to be doing a Facebook Live this Friday. Make sure you tune in for that because Joe is one of the smartest guys I know, and I haven't seen the spread in the magazine for him for next month, but I'm sure it's awesome, and he is awesome. So check out the Bigger Pockets Wealth magazine right now, 20% off in the Bigger Pockets store, biggerpockets.com/store. Use the code MAGAZINE like you see up there on the screen right now. You get the physical version, like literally you get a magazine delivered to your mailbox, and you'll also get a digital version of the magazine, a PDF format, so you can read it on the go. And I actually signed up. I'm waiting to get my first issue, and I actually have a column in there. So the Ask the Expert column, somebody decided I was an expert on something. So I am writing the Ask the Expert column where you sent in some of your most burning questions and I respond to them in the magazine. But here's the cool thing. I only got to answer a few questions in the magazine. On this Facebook Live right now, I'm going to answer any questions you come up with that I can answer, and we can go from there. Now, let me talk about something real quick because before we jump into the questions, and let's note there is a live comments section there. I hope you'll introduce yourself. Tell me where you're from. Tell me your name. But feel free to post your questions in the live comments or in the comments section, and we will go through those. I have an awesome friend of mine, Nikki Frick from Bigger Pockets, who is kind of managing this broadcast. So she's going to help me get through those questions. But let me start with, there's a whole lot of stuff going on in the economy, in the world, in the financial markets, in the real estate markets these days. And I am doing my absolute best to kind of keep everybody updated with my thoughts on what's going on. I love educating. I love writing about how things work. So I've made a concerted effort over the last few weeks to write a whole bunch of Facebook posts. If you don't follow me on Facebook, please follow me on Facebook. J. Scott Investor, but I write a whole lot about how these things work. And I get a lot of questions, people asking me, so how do I learn about this stuff? How do I learn about how financial markets work and the real estate market and the stock market and how all of these things kind of play together? People have questions about interest rates and inflation and printing money and all the stimulus packages. And what I tell people is, look, there's no one resource to learn all about this stuff. And it's not something that you're going to learn in school. I went to business school, but let me tell you something. 99% of the stuff that I have learned about and that I talk about and that I try and teach people about, I didn't learn in business school. You don't have to go to business school. My recommendation is for anybody out there that's a real estate investor or any type of investor, the most important thing today is to keep up with what's going on in the markets. And the best way to do that is to read and read and read and read. Go read an article on whatever topic. Pick any random topic. So yesterday, you probably, if you've been paying attention to the news or Facebook post, you probably noticed that the oil markets crashed yesterday. What does that mean? Well, go read an article about the oil markets and After reading that article, you're probably going to have 20 more questions. Well, here's the nice thing. We have this thing called Google. So if you read, oil market crashed, you can type into Google, what does it mean that the oil market crashed? And you're going to get an article that comes up and you're going to realize, the oil market didn't crash. It was the oil futures market. Futures contracts crashed. Well, what's an oil futures contract? Well, go back to Google and say, what is an oil futures contract, or what is a futures contract? And you're going to learn that a futures contract is just a way to buy some commodity in the future at a fixed price. What's a commodity? Go search on Google. So now that you know that a futures contract is whatever it is, well, now that's going to bring up 20 more questions. So go research what those questions mean and what those questions mean. And what you're going to realize is after a couple weeks or a couple months of just Googling every question you have about everything, instead of just reading something and ignoring all the extra questions that it brings up, instead of ignoring all the confusion that you have, power through it. When you have a question, write it down, go do some research and figure out what that means. And that's going to lead to 10 more questions. Get the answers to those 10 questions. That's going to lead to 100 more questions. Before you know it, you're going to start putting all of these pieces together. You're going to understand why the stock market is related to the futures market and why the futures market is related to real life price of airline tickets and food costs. And you're going to start understanding how all of these things are related to gold prices and interest rates and inflation and real estate. And at some point, after asking and answering all of these questions, everything's going to come together, and you're going to realize all these things that we talk about gold, we talk about inflation, we talk about interest rates, we talk about the futures market, we talk about oil, we talk about real estate. They're all related. And when something changes in one market, it affects other markets. And having this context, having this high-level understanding of how the whole financial world works is going to give you the context so that when somebody says, hey, oil futures crashed yesterday, you're going to be able to think, okay, oil futures crashed. That's going to be bad for oil companies. That's going to be bad for the states that rely on oil. That's going to be bad for the budgets in those states. That's going to be bad for the people in those states. That's going to be bad for unemployment. That's going to be bad for whatever unemployment is bad for. There's a whole bunch of things. And you're going to be able to make these logical connections, and you're going to be able to hear, instead of hearing the oil markets crashed, you're actually going to be able to figure out, what does that mean for me as an investor? Where does that mean I should be putting my money or not be putting my money? And that's the goal. Our goal shouldn't necessarily be to have to go to somebody else and say, what does this mean for me? But to understand in a larger context how all this works so that you can figure it out for yourself. So that's my challenge to everybody out there. Read everything you can. Start with a random post on Facebook, whether it's mine or somebody else's. Start with a random article on whatever your favorite financial source is, Forbes or Business Week or the Wall Street Journal or the Financial Times. Just pick an article, start reading, write down the questions that you have after reading that, the confusion you have, and start digging in and digging in and digging in. And in a couple months, you're going to be smarter than I am. Promise. Not that difficult. Okay. So let's see. We talked about BiggerPockets Wealth Magazine. Let me also mention that in the vein of reading, BiggerPockets, we know that a lot of us are sitting home right now, and we're using this time that we have, well, obviously we're all pretty busy. We still have our lives. But some of us have extra time to be reading, and it's pretty hard to get physical books off of Amazon these days. I actually went to order a couple books last week, and Amazon was a month out to send me a physical book. So these days I have been listening to a lot of audiobooks. I've been reading a lot of digital books. BiggerPockets in their publishing company, BiggerPockets store, BiggerPockets publishing store. What do I call that? BiggerPockets bookstore. There you go. If you go to biggerpockets.com/store, all of their books that are in audio and digital forms right now, and I think pretty much every book is in audio and digital form, are $10. So massive discount on those books right now. So it's tough to get physical books shipped to you in less than a couple weeks these days, but biggerpockets.com is doing a massive promotion on their audio and digital books. $10 right now. Go stock up on books. Okay. And if you're looking for a good book to read and you're interested in the economy and the real estate market, I released a book last year called Recession-Proof Real Estate Investing. And it's all about how the economy works, economic cycles work, and how we as investors, real estate investors, should be changing up our strategies and tactics throughout all phases of the economic cycle so that we can build our profits, build our businesses, and most importantly, mitigate our risk. So check out Recession-Proof Real Estate Investing as well. Okay. I am done plugging stuff. Now I want to turn to you guys and say, what can I help you with? What questions do you have that I can or hopefully can answer? Don't be dismayed if I give you a lot of I don't knows. There's a lot of stuff going on right now that nobody really knows where things are headed. I get the question all the time, where's the stock market headed? Where's the real estate market headed? And I'll tell you, I can guess, I can theorize, I can say if this leads to this, leads to this. I can give you 30 different paths of where things could go, and they all make logical sense. But without knowing whether that first domino is going to fall or that second domino is going to fall, I don't know if things are going to get much better in 3 months or they're going to get much worse. Nobody really knows. We can guess, we can theorize, we can plan and prepare for a worst case scenario, but nobody really knows. So I'm happy to talk about my opinions. I'm happy to talk about the economic data and indicators out there that lead me to these opinions. But please don't believe anybody when they say there's 100% chance that in 6 months, the stock market is going to be higher than it was. Housing prices are going to be higher than they were. Also, don't believe anybody that says, I guarantee you in 6 months, we're going to be in the middle of a recession or depression. Nobody knows. We're all guessing. And the best we can do is we can follow the data. We can learn about how the economy works. We can learn about how all of these markets interplay. And we can make and revise our best guesses as we get more information. The goal is always to be a couple weeks, a couple months ahead, but nobody's going to be able to tell you exactly what's going to happen in the next year because there's so many unknowns. Okay, so let's jump to a question by Joshua Kemp. I'm reading this for the first time. Jay, I'm Joshua. I live in West Texas. I can guess what the local ramifications on my local economy of the bottoming, dropping out of barrel of oil. What are your thoughts for an oil field region and then for the economy and the stock market as a whole? So let me give a quick overview of what actually happened with oil yesterday, because I know there's some confusion about this. People have talked about the price of oil. It was negative. People are basically paying to give you oil. Sort of true, not completely true. There are these things that I mentioned before, futures contracts. And I wrote a Facebook post about this. Go read my Facebook post from today. But long story short, there are a lot of companies that rely on oil for their business. So let's look at an airline. I used the example of Delta this morning in my post. Delta Airlines, they care about the price of oil because a very large percentage of their profits are based on the cost of oil. If oil is really expensive, that eats into their margins, that eats into their profits, unless they pass that cost on to consumers and they raise their ticket prices, but that also eats into their profits because then people don't want to travel. So for companies like Delta, one of the most important things is to be able to predict how much oil is going to cost in the future to run their planes, to fly their planes. So they don't want a big oil spike to jump out of nowhere. They sold all these tickets at some low price 3 months ago. Today, when they actually go to fly those planes, oil's really expensive. Now they're losing money on every flight. So they want to be able to predict their oil costs far into the future. So they can do what's called buying futures contracts. There are these things, there are these paper products where you can lock in the price of a commodity. A commodity is just an everyday thing that we tend to use or buy, these raw materials. You can lock in the price of everything from corn to pork to oil far in advance. So Delta Airlines, maybe last summer, they saw that oil was a pretty low price, maybe $30 a barrel. And they said, we want to lock in this $30 a barrel all through next year because we want to know every barrel of oil we buy, every gallon of oil we buy is going to be a specific price. So we can base our pre-sold tickets on that price. So they go out and they buy these future contracts. And these contracts basically say, you're now guaranteed to get this number of barrels of crude oil, not the stuff that goes in the plane, but the stuff that actually comes out of the ground at a certain price, let's say $30 a barrel. And so Delta Airlines says, great, now I know my price is going to be $30 a barrel for oil. I can price my tickets correctly and I can forecast my profits and my margins. I don't have to worry about losing money. And so they buy these contracts. Now, their goal isn't to actually, with these contracts, you're basically saying, I want 1,000 or 10,000 barrels of oil at this price at this point in the future. If you hold on to that contract, if you don't do anything with it, literally, at that point in the future, let's say it's a year out, you're saying, deliver me 1,000 barrels of oil or 10,000 barrels of oil at this price. Delta doesn't actually want the oil. They can't put the crude oil into their planes. It has to go through a refinery. So they're not actually looking to buy this oil. They just want to lock in the price of oil. If oil drops in price, they're then going to sell those contracts for a lower price. But they didn't have to worry about oil price spiking up and having to pay a whole lot more. If oil prices spike up, well, they're going to have to pay a whole lot more for oil, but now they have these contracts that they can sell. Other people are going to be willing to buy these contracts for a higher price, and so that's going to offset their costs. So these future contracts are basically an insurance policy against oil going up in price in a month, 6 months, 12 months, 24 months, however far out that futures contract is. Now, this is where it gets interesting. So the April futures contract, so at some point in the past, companies like Delta bought contracts to actually buy oil for April 2020, and they expire today. So yesterday, Delta looked and they're like, okay, we're holding, and I'm just using the example of Delta, maybe not Delta, but some companies looked and said, we're holding these contracts. As of tomorrow, those contracts expire. We physically need to take delivery of all that oil that we agreed to buy when we bought those contracts. Again, we never anticipated taking delivery. What we do is we sell those contracts. So they're going to sell those contracts just like they always do. Typically, they're going to sell them to the places that store oil, or they might sell them back to the oil producers who are going to buy them because they're the ones producing the oil. They're happy to buy those contracts back at a lower price. But here's the thing. The oil producers have so much oil these days because they're still producing, but nobody's using oil in this economy. Nobody's using oil. Nobody's driving anywhere. Nobody's flying anywhere. So all these oil wells are producing this oil that's sitting in barrels, and there's no place left to store all the oil that's coming out of the ground. So normally Delta would take these contracts, sell them to somebody that's willing to actually take delivery of this oil, and nobody wants to take delivery of this oil because nobody has any place to store them. So normally, like if there's a lot of supply and not a lot of demand, these contracts would go for a low price. Maybe Delta bought them for $30 a barrel back last summer, and now the price of oil is plummeted because there's so much supply, and they're now going to sell these contracts for $10 a barrel or $5 a barrel. Well, let me tell you something. These companies that actually store the oil, they're not even willing to buy oil at $5 a barrel or $10 a barrel or $1 a barrel. They literally have no place to store it. So literally Delta has to say, I'm going to pay you money to take this oil. I'm going to pay you money to buy these contracts off of me because we don't want to take delivery of this oil. And so these companies are saying, okay, you're going to have to pay me $20, $30, $50 a barrel just to take this oil from you because I have to figure out a place to store it. So these negative oil prices that we're hearing about, it's actually negative futures prices. And companies like Delta are paying to get rid of these contracts and selling them to companies that now have to figure out where to store all this oil. But if you pay them $20 or $30 or $50 a barrel, they'll figure out a place to store it. So that's the negative. We're not really going to see negative gas prices at the pump. Our gas station isn't actually going to pay us to fill up our tank. But because there's so much oil out there, we are going to see prices drop. So it's going to be cheaper to buy gas at the gas station. Problem is, nobody's really traveling right now. Nobody's buying plane tickets. Nobody's driving. So does it really help us that much? Sure, it helps a little bit, but it doesn't help tremendously. At the same time, these oil wells that have nobody to sell this oil to because nobody can store it. They can't store it. The refineries can't store it. Nobody that's buying oil has any place left to store it because all the barrels, all the tanks that they've used are filled up because they can't sell the oil. These oil wells now have no place to store this oil. So what do? Well, they can pump the oil out of the ground and figure out a new place to store it, or they can stop pumping the oil out of the ground. Unfortunately, the way oil wells work, if you stop pumping oil out of the ground, you can't just start again in the future. It's not a tap that you turn on and off. If you stop pumping oil out of a well, You've basically destroyed, or there's a good chance you've destroyed that well. So by stopping production or slowing production, a lot of these oil companies are likely to go out of business, which means it's going to hurt tax revenue. It's going to hurt the states that rely on oil revenue. So Texas, California, Alaska, North Dakota, all these states that make a whole lot of money by exporting oil, they're going to start to lose money. The unemployment's going to go up because there are a lot of jobs in these states based on these oil prices. So the ramifications of having too much oil, in theory, it seems good. Yeah, too much oil, prices go down, but the ramifications are actually really bad. And so I think what we're going to see, so that was a really long way of getting around to Joshua's question, which was, I think that this oil crisis is going to cause a lot of companies to go out of business. It's going to cause unemployment in certain states like Texas and Alaska and North Dakota to skyrocket. It's going to cause these states to have budget problems because a lot of their budgets, a lot of their tax revenue is based on the export and the sale of oil from their states. And sure, it might help our prices at the pump short term, but longer term, it's going to hurt our economy more than it's helping us as individuals. So I think what's happening in the oil market is actually a really bad thing. I wrote a couple weeks ago about the risk to our economy. And basically people have been asking me, where do I see things in 3 or 6 or 12 months? And I talked about the fact that I think when we get out of this lockdown, there's still going to be a lot of people looking for jobs. A bunch of businesses are going to have gone out of business. And I think we're going to see kind of not so good numbers, typical recession type numbers. We're going to see unemployment 6, 7, 8, 9, 10%. We're going to see GDP, which is the total output, economic output of the country, flat, not growing, probably shrinking a little bit. It's going to look like a typical recession. Then the question is, where do things go from there? 6, 12 months down the road, do they get better like a typical recession? Do things kind of trend back up? Or do we see a big crash? And the answer is we don't know, but I highlighted 3 specific risks in the next 6 to 12 months that I think could, if things go in the wrong direction, could lead to a major downturn, a major recession, or even a depression. And again, those 3 things are, number one, I personally didn't think that the economy was perfect leading into this whole lockdown, this whole coronavirus situation. There were cracks starting to emerge. So consumer debt is at an all-time high. Corporate debt is at an all-time high. Tax revenue is down. Manufacturing has been in a slump. Retail was starting to slump. Inflation was starting to increase. So there are a whole bunch of things that we don't get me wrong, we had a great economy leading up into the beginning of this year, but it wasn't a perfect economy. And a lot of the reason we were able to keep that economy going was because we've been lowering interest rates over the last year or so. And lowering interest rates spurs the economy, it keeps the economy going. Interest rates are now at 0. We can't lower interest rates anymore without going negative, and that's a whole separate discussion. If we need to spur the economy even more. So there are a whole bunch of things that were going on in the economy that were kind of, they weren't great, and there were some risks. Well, what's happened over the last couple of months of basically being in lockdown, shutting down the economy, that could lead to some dominoes from those previous economic risks starting to fall and starting to cascade. So the first big risk I saw was that some of these issues that were systemic in the economy before the pandemic could become a bigger issue now that we have the pandemic. So that's the first thing. Second thing was that we don't know when this lockdown is going to end. It looks like it's probably going to end in a lot of places in the next few weeks, but we've heard in other countries that it's basically they've gone into round 2 or round 3 of the lockdown because the virus starts to reoccur. And so we don't know if there's going to be a round 2 of this lockdown this summer or next winter or next spring. A lot of unknowns about, like, is this the end of the lockdown, or are there going to be more lockdowns that hurt the economy? So that's the second unknown. And then the third unknown is kind of all the unknowns, all of the unintended consequences of the economy being shut down and the government doing crazy stuff that needs to be done. Don't get me wrong, but it's crazy stuff that the government needs to do to keep things moving, injecting trillions of dollars into the economy, giving out stimulus checks. These are things that we've never really done at this scale. What breaks when you start doing those things? What breaks when you shut the economy down? Now, there are a lot of really smart people out there. I don't count myself as one of them. There are a lot of people a whole lot smarter than I am who go through these kind of brainstorms of what breaks because of all this stuff. And I don't know about you guys, but I hadn't heard anybody suggesting that what breaks is oil has no place left to be stored. There's too much oil out there, and that causes the oil market to crash. It was an unintended consequence that nobody that I knew predicted. I'm sure there's somebody out there that was thinking about this, but most people never even thought about this. So there are all of these unintended consequences that could happen that could really destroy our economy longer term, that could lead us from what's likely to be a typical recession into something much worse. So is the oil thing, is that the last market? Is that the last domino that we're going to see fall, the last unintended consequence? Probably not. What are the next 3 or 4 or 5 unintended consequences? I don't know. That's why they're unintended. We can't really predict them. And so it's possible that this oil market crisis could lead to some other crisis, some other crisis, some other crisis. And we see a domino effect of things we can't even predict right now. So that's why this is important. That's why all of this matters, because this oil market thing is probably not a one-time, it's the only thing that's going to break and then we're going to get back. We've already seen problems in the repo markets, which is the short-term lending market. We've seen problems in the mortgage market. If you've been paying attention to my posts, we've seen problems in the mortgage servicing market. We've seen lending tighten for reasons that we sort of could have predicted, but we never really thought about. We've seen unintended consequences in a lot of places. Oil's only the most recent, and my guess is over the next couple of months, there's going to be a whole lot more unintended consequences that may lead to something much bigger and much worse. It may not. We don't know. So, but that's why it's so important. Okay, let's see. Nikki, feel free if there's a question up there that you saw to throw it up. So Terry asks, will this force innovation? I thought we were looking for ways to go away from oil. These conversations had to do with the possibility of running out of oil. So certainly innovation is a very important word right now. Innovation is the thing that makes countries powerful. Now, we talk about a powerful military, we talk about a powerful currency, but at the end of the day, the thing that drives the currency, the thing that drives the economy is innovation. The reason economies expand, the reason economies do well, there's one thing: productivity. And the more productive a country is, the better their economy is. And when I say productivity, I talk about total output or average output per worker in the economy. And the more I'm going to get this word wrong every time, the more productive an economy is, the more productive workers are, the more productive companies are, the better that economy is going to do. And as long as productivity outweighs all the negatives, so let's say we're printing a lot of money and we're watering down the money supply. Let's say we are handing out like lots of social welfare. We're giving people stimulus checks every month. Let's say we're spending stuff. Let's say there's oil problems like we've seen in the oil markets. As long as productivity is going up, and as long as productivity can increase at a rate that kind of negates all the bad stuff, an economy is going to grow. And a currency is going to stay powerful, and a currency is going to stay strong. It all boils down to productivity. What drives productivity? At the end of the day, what drives productivity is innovation. So the reason that the United States is such a powerful nation is because 100 years ago, we were able to innovate around assembly lines and manufacturing. The reason why we've become such a strong nation over the last 20 years is the internet and the way we've really been able to leverage technology. And however long it takes for us to say, okay, what's that next big thing? If another country came along, let's say some small country, let's say Albania came along, and I'm just making that up, came along and was able to come up with some really great innovation that drove productivity in their country, that drove output in their country, well, they're going to get stronger. Their economy is going to get stronger. Their currency is going to get stronger. They're going to become more powerful just in relative to other nations in the world. And so driving innovation, driving productivity is literally the most important thing when it comes to an economy. So this is where and we could have the political conversation. I don't want to have a political conversation, but this is where capitalism really shines. With productivity or with capitalism, you give people the incentive to be innovative, to increase productivity, to create the technologies that increase productivity, to create the systems that increase productivity, to create the companies that allow other companies to be productive. And that's I mean, don't get me wrong, there certainly capitalism isn't perfect. There are things that we could refine and make better. But the best thing about capitalism is it encourages people to be innovative. It encourages people to increase productivity, and that encourages the growth of economies. So I think what we're going to see with this whole oil thing is hopefully the government's going to get out of the way, and they're going to say, let the free market, let the market figure out how to be innovative. Let the market figure out how we can be more productive. Maybe that's better ways to store oil. Maybe that's ways to need less oil, and so companies can basically get by with less oil. Maybe that's getting rid of oil altogether and creating new energy technologies, and we're already doing that. But maybe this is the time to kind of get out of the way and say, let's put in place these new energy technologies, because that's going to be more innovative and drive productivity. Maybe not. I don't know. I'm not giving the answer. I'm just saying that this is a fantastic question, Terry. This will force innovation. And hopefully the government will allow the free market to act. Hopefully they won't. And in the past, we've seen the government take a big interest in the fossil fuel industry. They really want to help the oil companies. And this is bipartisan. This is both parties, Democrats, Republicans, probably every other party on the extremes. They love the fossil fuel companies because the fossil fuel companies pay them. They get paid in their campaigns. They get paid in sponsorships. They get paid everywhere. And this is bad for the economy because it doesn't allow free market innovation and productivity. So yes, hopefully this will be an opportunity to force innovation and either go away from oil or make oil more efficient and create innovation that allows oil to be used in a way that's better than those alternative energy markets. Or we just go to those alternative energy markets. I'm not staking a claim and saying one's better than the other, but yes, this will force innovation. Okay. JJ says, Jay, if we do see a recession, very provable, you might have meant probable there, but do you see foreclosures coming as well with all these deferrals, et cetera? If housing prices fall, what typically happens to rent rates in your opinion? So this is another one of those we don't know the answer. In a typical recession, there is a reasonable chance. So let's walk back a little bit. During a typical recession, we may or we may not see a major impact on the housing market. 2008, obviously, we saw a huge impact on the housing market. That recession was actually driven by housing. There were issues in the housing industry. There were issues in the mortgage industry. The 2008 recession was a real estate recession. Probably the first one we've had in over 100 years. Typically, recessions are driven by something other than housing. So you go back to 2000, and it was driven by the internet bubble. It was driven by 9/11. You go back to the early 90s. In the late 80s, there was the savings and loan crisis. You go back to the 70s, and there was an oil crisis. You go back to the 30s and the Great Depression, and that was driven by tariffs, and that was driven by little bit housing and unemployment. And so every recession, every downturn has its driving functions. Some of those result in major issues for the housing market. So 2008, obviously, housing market got crushed. Go back to 1990, housing market got hit pretty hard because there was a problem with lending and banking, just like in 2008. Then you look at like 2001. 2001, the real estate market didn't get hit that hard. Certain markets like I think San Francisco, New York, like took a nice big hit for a real short period of time. But in general, the housing market wasn't disproportionately affected in 2001 or 1990. Go back to the early 80s, there was a couple big housing crunches. Go back to the 70s, housing wasn't affected that much. So we don't know exactly what the ramifications of a recession based on something unrelated to housing, like the pandemic, is going to have on the housing market. What we can say is that when people lose their jobs, they can't make their mortgage payments. When people lose their jobs, they can't afford to buy new houses. When people start to see their wages cut or their hours cut, they typically aren't going to be making the amount of money that they locked in for their mortgages at some point in the recent past. So a lot of people, even if it's not a housing crisis that we're seeing, a lot of people are going to be impacted generally by the financial downturn, and that's going to lead to certain things in the housing market. We just don't know how bad. It's likely values are going to fall, especially given affordability. One of the constants in, if you look at the recessions that hit housing the hardest, some of the things we saw leading in were affordability was a big issue. Back in 1990, back in 2008, leading into those recessions, affordability was a big issue. Houses weren't affordable. And we see that a lot today as well. Affordability in a lot of markets is really bad. And so if you look at that as a commonality in the recessions that hit housing, we're seeing that again. So it's very possible that this one could hit housing because we're seeing the same kind of affordability issues we saw leading into the last couple recessions where housing got hit hard. So does this mean housing is going to get hit? Does this mean foreclosures are going to spike? It could, but it doesn't mean that that's going to happen. It doesn't mean that it's going to be a 2008 event. But like I said, in a lot of these recessions, what happens is we see these dominoes of unintended consequences. Things happen that we can't predict. So we don't know if this whole lockdown, oil crisis, repo crisis, mortgage servicing crisis, all leads to people starting to default on their debt because they find it harder to get credit. And that default on debt leads to foreclosures, which leads to a housing shock, which drops prices. That could happen. But we don't yet have enough information. Right now, what we're dealing with is so unprecedented. And like you mentioned, there are things like forbearances and there's things like a moratorium on evictions that kind of throw the whole thing out of whack. We no longer have the free market of a lender says you're not paying. Well, I'm going to take your house back. Or a landlord saying, you're not paying rent, I'm going to kick you out. So we've ruined the free market aspects. And when you ruin the free market aspects, we don't really have models that say, how does that play out? We don't know if just 3 or 4 months of taking away the free market aspects of housing, is that going to destroy the whole industry? Is it going to come crumbling down? Or is it just going to be a weird 3 months and then everything gets back to normal? We don't know because we don't have data. Unlike physics where you can kind of build theories and test them, with economics, it's really hard. We can build theories, but you can't create a scientific experiment, a small scientific experiment to test your theories. Basically, with economics, we just look at things that happened in the past and we say, okay, this looks similar to that. If you read Ray Dalio, if you don't read Ray Dalio, by the way, I'm going to go off on a little tangent here. There's a guy named Ray Dalio. He's an economist. He owns a $1 billion hedge fund. One of my favorite people to read everything. He if you haven't watched, there's a YouTube video called The Economic Machine in 30 Minutes or something like that. Go watch that. Best 30 minutes of your time today. He has a couple books. Big Debt Crisis is a great book. So read Ray Dalio. But Ray Dalio does a really good job of kind of going back. He has a couple books that basically go back for the last 150 years and say, here's the reason every recession has occurred. Here's the commonalities. Here are the things that we can learn from past recessions. And that allows us to say, okay, the things we're seeing today, what are they most like? Were they most like the 1980 recession? Were they most like the 1974 recession? Were they most like the Great Depression? And when we say, well, here are the initial conditions are most closely related to the initial conditions of X, we can say, well, the most likely result is what we saw in X. And one of the things Ray Dalio talks a lot about is that the initial conditions, the conditions we're seeing today, and when I say today, I mean just the last couple years, is that things are very, very similar to what we saw right before the Great Depression. Great Depression was driven by high debt. Great Depression was driven by trade wars. So a lot of people don't realize this, but a lot of what happened with the Great Depression and shortly after it started was driven by tariffs. And just like we have tariffs and trade wars today, not saying it's necessarily the same reasons that we're doing it or did it, or that the ramifications will be the same, but a lot of the initial conditions today are like what we saw back in the 30s, and so the 1930s. And so if you ask somebody like Ray Dalio, he would say that's literally the best model we have for where things are headed. And guys like Ray Dalio would say he thinks we're probably headed into a major, major downturn. Is it going to be as bad as the 30s? Again, nobody knows. But if he had to guess, and if you listen to him, he's pretty bearish. He's pretty negative and cynical on what's likely to happen, because what we're seeing today is so closely analogous to what we saw 100 years ago leading into the 1930s. So anyway, what are we likely to see? I don't know. Is it going to affect housing? I don't know. But a lot of people who are a lot smarter than I am think that there's a really decent shot that there could be a domino effect, a cascade effect that kind of pulls the entire market, the entire economy down for a couple years. And if that happens, I think it's probably safe to say that housing is going to get hit. We're going to see a spike in foreclosures. I'm not going to surmise whether it's going to be better than 2008 or worse than 2008 or better than the 1930s or worse than the 1930s. But I will kind of go on record as saying my guess is that this is going to be worse than a typical recession. This is going to be worse than a typical downturn. And when all of this plays out, the next 3 or 6 months might not be that bad. But once we start seeing some of those unintended consequences, once those dominoes start to fall in 6 to 12 months, I think it could be bad. Now, that leads to the question of what do we do? We're investors. So things get bad. Do we kind of curl up in a ball and crawl into bed and cry? No. Now is the perfect opportunity, because I'm telling you, and because other people are telling you that in 6 to 12 months, things could get bad. The nice thing there is we now have 6 to 12 months to plan. And worst case, I'm wrong. Ray Dalio's wrong. Other economists are wrong, and things don't get bad. But let's say they do. We now have 6 to 12 months to plan. That gives us 6 to 12 months to go out and shore up our financial positions, to work on our credit, to save money, to move to cash where we can move to cash, to sell off those investments that we don't want to hold during a downturn. It gives us the opportunity to go out and start reading. Go read books, go read articles, go read magazines, and prepare. Do everything you can to think, this is what I would do. Everybody talks about 2008, and they talk about, wow, I wish I could go back to 2008 again because there were such great opportunities as investors. Well, let me tell you something. You may have that opportunity. And let me tell you something else. It's not all teddy bears and roses and like it seemed. Let me tell you something. 2008 sucked. It was scary, and I know everybody wishes we could go back and have that opportunity again. But when you're in the middle of it, it's not something that's fun. Sure, there's opportunity, but you're also sitting there wondering, is this going to last like 5 years or 10 years or forever? And you can't really put yourself in that mindset until it happens. So don't think that yes, it could be a great opportunity, but don't think it's going to be a great fun opportunity. Don't think that you're looking forward to what's going to happen, but be prepared for it. Okay. And now is a great time to spend the next 6 months, go into the Bigger Pockets bookstore. Every book that you can think of that might be related to a topic that you want to learn about and get better at, go take a look. Again, I hate to plug my stuff, but go read Recession-Proof Real Estate Investing, because I talk all about which strategies tend to work best during a downturn and then which strategies tend not to work well. I do have another book, and again, I hate plugging myself, but I have a book called The Book on Negotiating Real Estate that I wrote with my wife, Carol, and Mark Ferguson. And during a downturn, you're going to be buying, hopefully, a lot of deals directly from sellers using creative financing techniques. You're not necessarily going to be able to get loans easily. So I wrote an entire book, or we, mostly Mark and my wife, wrote an entire book on how to negotiate with sellers and how to do creative financing and how to structure offers and how to analyze deals. So now's a great time to learn how to negotiate and how to structure these seller financing deals. Brandon Turner has a book called Investing with Little or No Money Down, which is another great thing, because again, lending is tight during a downturn. So go check out Brandon's book. Go check out Dave Van Horn has a great book on investing in notes. Now could be a great time to start learning about note investing. Burr strategy is still great. It's tougher to refinance. You have some risk on the refinance piece of the Burr strategy. But David Green has an amazing book on the Burr strategy. Amanda Hahn has a couple great books on tax strategies. Be familiar with all the great tax strategies that you have access to. So now is a great time to be preparing. And then there are a whole lot of books outside of Bigger Pockets. I'm not just saying just buy the Bigger Pockets books. Bigger Pockets, as far as I'm concerned, has the best books because that's their goal. They don't put out a book unless it's going to be the best on the topic, but there are plenty of other books out there. There's articles, there's movies you can watch, there's videos you can watch. Go spend the next 6 to 12 months learning absolutely everything you can to prepare for what might come. Okay. Let's see. So Greg Purcell says the best advice is to wait. Yes, this is exactly the worst thing for the market and sellers, but the best thing for individual buyers. I agree with Greg. So it's funny because a few months ago, I would have said, when's the right time to buy real estate? It's always the right time to buy real estate. Today is a little different. We are really in an unprecedented situation. What I tell people today is now is not the time to actually be putting out money. If you have properties you want to sell, great. Go try and sell them because this could be your best opportunity to sell right now. But if you're looking to buy, now is a better time to prepare. Now is a better time to read. Now is a better time to learn. Now is a better time to educate yourself, to get your credit in order, to get your cash position in order, just all the things I said before, and wait to see where things are headed. Because right now we're not in reality. Whatever we're seeing in the real estate market right now, the markets are so inefficient. There are so few deals being done. There's not a lot of supply. There's not a lot of demand. So anything we're seeing, we can't really trust the numbers right now. So we don't know when this whole lockdown ends. I have a feeling when the lockdown ends, we're either going to see prices shoot up or shoot down. And we don't know which one it is. I think it's going to be more towards the downside, but I could be wrong. But I think what we're likely to see is either shoot up or shoot down. And because we don't know which direction it's going to go, investing right now is highly risky, especially for those investors that don't have a lot of experience. But I don't think that this wait period is going to last very long. I think 3 to 6 months from now, we're going to be in a situation where the markets are a little bit more stable, where it's a little bit more clear which direction we're heading. So again, use those next 3 to 6 months. Don't curl up in a ball and crawl into bed and close your eyes and ignore the world around you. Use that time to learn. Use that time, get them Bigger Pockets and participate in the forums and become an expert, because there are so many people that are sitting on the sidelines kind of focused on other stuff right now that in 6 months, when the time comes to do something, whatever that something is, if you've spent the last 6 months preparing and being ready and putting together a plan, you're going to be so far ahead of all those people that kind of just curled up in a ball and ignored what was going on. So yeah, Greg, I absolutely agree. Let's see. What is the best tool to use to estimate repairs? UGG. So I told you I hate plugging my stuff. I do have a book called The Book on Estimating Rehab Costs, which lays out a methodology for how to estimate rehab costs for a project. It basically says any rehab project is broken down into 25 major components: the roof, the carpentry, the cabinets and countertops, the plumbing, the electrical, the HVAC, 25 major components. And then within each of those major components, there's dozens and dozens of subcomponents for each of those things. So you can repair a roof, you can replace a roof, you can replace it with tile or asphalt shingles or metal. You can replace gutters, you can replace downspouts. There's a million different like sub things. And basically my take on the best way to estimate repairs is to learn the process, learn these 25 major components, understand each of the subtasks within those components. And then when you walk through a house, you basically have a checklist. You say, okay, look at the roof. Based on what I know about roofs, and you have to learn to like look at a roof and inspect it and say, based on what I see in the roof, well, permits say the roof was replaced 15 years ago. It looks to be a 25-year roof, so it probably has 10 years left on it. The granules are starting to come off and starting to wear in some places. There's some fungus growing on the roof. There's some bare spots. There's a shingle missing. Based on all those things, can I repair it? Do I have to replace it? If I have to replace it, well, how big of a section is it? Okay, maybe it's the whole roof, and I can estimate that the roof is a 2,500 square foot roof based on certain measurements, and then I can find out that to replace a roof, it costs me $300 per square. A square is 100 square feet, so 300 squares or $300 a square at 2,500 square feet ends up being $7,500. Great. Now I know my roof is $7,500. Do that for each piece of the rehab, put together what's called a scope of work, which is literally a line item of repairs, labor costs, material costs, add it all up. And that's how you estimate repairs. In terms of tools, BiggerPockets, use the calculator. So if you're a BiggerPockets Pro member, there's a calculator that will allow you to estimate repairs, and it's based off the book. So it's essentially it's these 25 components and the subcomponents, and you fill in and it adds it up. If you bought the book on BiggerPockets, it comes with a whole bunch of spreadsheets and digital files, Excel files that allow you to do the inspections. It tells you some inspection tips. It gives you places to fill in labor and materials for each component. If you bought, let me throw this out there. If you've bought your flipping or estimating books on Amazon, you didn't get all those digital files, shoot me an email, either a PM on BiggerPockets or an email, j@jscott.com, just letter J at jscott.com. Say, I bought the book on Amazon. I will send you those files because those are really valuable. I don't want anybody not to have access to them. But basically, the best tool to use is just use the BiggerPockets calculator, use the spreadsheets that I've posted on BiggerPockets or that come with the books, and learn the process. Because estimating is a process. It takes time to learn. It takes a couple months to learn. But once you do, you now have an advantage over 90% of other investors out there that don't do a good job of it. Let's see. Don asks, at what time should I start looking to jump back in? What signs are you looking in the economy to jump in? Basically, what I'm looking at is what I refer to as an efficient market. So a market is just a place where things are bought and sold. So a real estate market is just the place where real estate is bought and sold. Stock market is a place where stocks are bought and sold. Oil market is a place where oil is bought and sold. And what makes a market efficient is when there are lots of buyers, lots of sellers. A lot of supply, a lot of demand. And when there's a lot of buyers and sellers, we get a good indication of what prices should be. Let's say, let's look at an inefficient market. Let's say the high-end art market. If you have a copy of the Mona Lisa, how much is that Mona Lisa worth? It's really hard to tell you if the Mona Lisa is worth $5 million or $50 million because there's probably only 3 people out there that are going to be looking to buy it. So in a market where that's really inefficient, you don't have a lot of buyers, you don't have a lot of sellers, and there's only one Mona Lisa. In a market like that, we don't really know what the real values are until we actually try and sell something. Somebody can say the Mona Lisa is worth $50 million, but if I go to sell it tomorrow, if there's only 2 people out there looking to buy it and both of those are just like, no, I don't feel like buying today. Well, now the Mona Lisa is worth 0 because you can't sell it. That's an inefficient market. If there are 10,000 or 100,000 or 1 million people out there that can buy the Mona Lisa, well, now we're going to get a good idea of what the value is because there's enough people to compete against each other. That's what we're seeing in the real estate market right now. Because there's not a lot of buyers, not a lot of sellers, relatively speaking, the market's really inefficient. So we can see that in one area, prices are kind of staying solid to what they were leading up into this crisis. But because there's not a lot of buyers and sellers, we can't trust that data. We can't say that the market's really staying where it was, or maybe it's going up. We can't say that it's really going up. Maybe we've seen it go down, but we can't really say that it's dropped because without a whole lot of volume, without a whole lot of buyers, a whole lot of sellers, we have an inefficient market and we can't trust the prices in an inefficient market. So when should you start jumping back in? My take is once we get past the lockdown, once all the buyers that want to be out there buying can be out there buying, once all the sellers that want to be selling are out there selling, and we get back to what's referred to as an efficient market, we've got lots of supply, lots of demand, then we're going to see where prices are really going. We're either going to see prices have stayed steady from before the lockdown, they've gone up, or they've gone down. And again, I've said I think they're probably going to go down. But it's once we get back to this efficient market and we see where prices kind of settle in at, that's going to be the right time to jump back in. Now, from there, we don't know. Prices could go down, they could go up, they could stay flat. So there's still going to be risk. But I think once we have an efficient market and we have an idea of where prices are going to settle after all of this lockdown, that's going to be the right time to start thinking about what the strategy is, because we're going to have a whole lot more information about what's happened. So hopefully that makes sense. Mike asks, so you said the BRRRR strategy might be a little risky right now. Is there a solid backup plan if you have one or two going on now to refinance? Can we expect lending to get back in 6 to 12 months? So let's start with the second half of your question. Can we expect lending to get back in the next 6 to 12 months? The answer is I don't know. Again, I think things are, if this were a typical, let's say we just entered into a typical recession, we have really good data on recessions. We know the typical recession lasts a lot shorter than the expansion phase. So let's say an entire economic cycle on average lasts 6 or 7 years. We know that the recession part is generally just 1 or 2 years of that. And then we have that expansion, that growing economy for the other 5 years. And then we see the downturn and 1 to 2 years of the downturn and 5 years of the upturn. This is different. So this isn't a typical recession. If it were a typical recession, I'd say, yeah, give it 12 to 18 months and we'll probably be back to where we were. Lending will have loosened up. We'll have hit a bottom and we'll start going back up. But because things are so different this time, because we don't know how long the lockdowns are going to last, we don't know what dominoes are going to fall, we don't know what unintended consequences are, it's possible that 6 or 12 months, yeah, we could be back to normal. Everything could be growing. The economy could be great. Or 6 to 12 months could just be the start of a major downturn. We don't know. So what I'm telling people is BRRRR is a great strategy. And for those that don't know, BRRRR is, and David Green has a great book called BRRRR Investing. But the B stands for buy and the R stand for renovate, rent, refinance, repeat. So it's basically you buy a property, you take out a short-term loan on that property, you renovate it, you get a tenant in there, you refinance it to pull out all of your money after about 6 to 12 months when the property is now worth a whole lot more because you've renovated and put a tenant in. And now you've hopefully gotten most or all of your money out, and you repeat, you do it again. It's a great strategy, but the strategy relies on you being able to do two things. One, you have to be able to get the money up front to buy the property. And then number two, you need to be able to refinance into a longer term loan after you have a tenant in there to pull your money out to do that repeat piece. The hard part is these days, because lending is getting tighter, we don't know if people are going to be able to do that refinance piece in 6 to 12 months. It may be impossible to get a refinance on a rental property. It's really hard right now. You need a lot of cash reserves. You're not getting as much out as you previously were. Appraisals aren't coming in where they were. In 6 to 12 months, it may be all fine and back to normal, but it may not be. So that's the risk. So what I tell people is if you're doing the BRRRR strategy right now, there's you got the money to do the original purchase from somewhere. Maybe it's a hard money lender. Maybe you took it out of your savings. Maybe you took it on credit card. Maybe you borrowed it from a family member. Maybe you partnered with somebody. My suggestion is whatever strategy you use to get the initial purchase price, talk to that lender and make sure that if in 6 to 12 months when you go to refinance, that lender will give you some slack if you can't refinance. So maybe you got it from a hard money lender. Go to that hard money lender and say, hey, Bob, whatever his name is, I'm a little concerned that in 6 to 12 months, I get a tenant in here, it's cash flowing, I'm making money every month, but I'm concerned I'm not going to be able to refinance. If that happens, what would you do? And if that hard money lender says, yeah, I'm going to take the property back from you and I'm going to foreclose, well, you probably don't want to work with that lender. A good lender would hopefully say, yeah, I understand that's a risk. What I would likely do is I'll extend the loan. Maybe I'm going to add a point and I'm going to make you pay some percentage of the loan amount as kind of a penalty. Or maybe I'm going to increase the interest rate a little bit. But I'm going to work with you because I know you have rent coming in from the tenant. I know you can afford to keep paying. If in 6 to 12 months you can't refinance, I'm going to extend that loan for a year or 2 years or 5 years. And here's what the penalty is going to be. Here's what the new interest rate is going to be. That's a much better situation because now you have a backup plan. And you can say, okay, I'm going to run the numbers based on that worst case scenario. And he said he's going to charge me 2% of the loan and he's going to increase the interest rate 2%. So now you run the numbers based on your anticipated rent, and you say, okay, that worst case scenario, I can still make the numbers work for a year or 2 or 3 until I can refinance. And now it's a good deal. You can move forward. So anybody out there that's looking to do a BRRRR property, talk to your short-term lender. Make sure that you have a backup strategy, a backup plan, a plan B for if you can't refinance. And now that becomes your plan A if you can't refinance. If you don't have a plan B, if there's nothing you can do, if you're just going to lose the property in 6 to 12 months because you can't refinance, you can't come up with the cash anywhere else, you may consider not doing that deal, because that's probably a risk. I can't speak for you. It's a risk I wouldn't want to take. So have a backup plan or be willing to take a big risk. Let's see. Okay, Gareth, I'm sitting on a high-end flip. Should I switch strategies and BRRRR the property, minimize rehab costs, or just try a wholesale and break even? Okay, first, if you're buying a property right now, don't buy a flip right now without having a plan B, C, D, E, F, and G. So Gareth may have bought this a year ago before we saw any of this coming. Didn't have a plan B or a plan C. I know I've bought properties a year ago, and I didn't really have a plan B or plan C because I really thought the market, we had a few months left. So if you're buying a property now, for anybody that's looking to buy a property now, make sure you have a plan B and think, if I can't resell this, what am I going to do? So what I would say to you, Gareth, is if you're sitting on a high-end flip, first of all, I don't like high-end anything at the top of a market. The problem is when the market starts to slow down, even if we didn't have this pandemic, even if we just had a typical slowdown, typically high above median price point, far below median price point, those are the properties that tend to slow down first. So I've kind of been staying away from high-end flips. I know it's too late to be giving this advice to you, but to anybody else that's listening, that's thinking of buying a high-end flip, don't buy high-end, don't buy low-end. If you're going to be buying properties during a downturn, focus on the median price point, because that's where the bulk of your buyers are going to be. That's where it's going to be easiest for your buyers to get financing, long-term financing. But you're sitting on a high-end flip. So what I would suggest is run the numbers on other backup scenarios. So can you rent it out and cash flow? If you can't rent it out in cash flow, can you rent it out and lose a small enough amount of money every month that you can continue to finance the property for the next year or 2 or 3 until you can sell it? Can you do something else with the property? Can you break it up and turn it into a multifamily type property so you're getting multiple times the rent? Can you turn it into an assisted living facility? Can you somehow arbitrage it to somebody else that wants to use it as, I mean, these days Airbnb isn't a reasonable strategy, so you're probably not going to be able to do that. But think about all your other potential strategies for the property. Can you do a lease option? So can you get somebody else in there to pay you an option fee with the right to buy the property at some point in the future, and they pay you rent? That option fee can offset your losses for a couple of years. Sure, they may buy the property from you. They may get to lock in a reasonable price now, but that gets you a fee up front that you can use to kind of pay off the monthly losses. So a lease option is potential. If you can't do any of those things, if none of those things sound appealing, the best strategy may just be to dump the property. One of the biggest mistakes I see investors make at the beginning of a downturn is they don't sell quickly enough. They say, oh, I was planning to make a 20% profit. The market's dropped. Now I'm only going to make a 5% profit. I'm not happy with a 5% profit. I'm going to try for 10%. And so they overprice it by a little bit, thinking that's the money I want to make. It doesn't matter what you want to make. The market's going to give you what the market's going to give you. And so sometimes people are like, I'm not ready to drop the price to where I know I can sell it. So they price it a little bit higher. Well, then the market drops more. And they go, oh, well, now I'd be happy with a 5% profit. So they drop it to that price where it was a month ago, but now it's lower. And they're like, well, I don't want to break even. I need a little profit. So they drop it, but they don't drop it enough. And then the market drops even more and they say, oh, well, damn, I should have sold it at a break even. Well, now I'm willing to accept break even, but now the market's at negative 5%. And so they're constantly chasing the market down. Don't do that. If you find yourself in a situation where you really need to get rid of a property, remember, typical recessions are going to last 6, 12, 18 months. So if we're just starting one, if you believe, and again, I don't know where the market's headed, but if you believe that we're starting at least in a recession, things are going to get worse in the next 6 to 12 months. So don't chase the market down. If you have to get rid of the property, underprice it, even if it means breaking even, taking a loss. It's better than chasing the market down and taking a bigger loss later, or trying to implement a plan B that doesn't work. The biggest thing I would say right now is if you're sitting on a loan for that property, figure out a backup plan for the loan. So if worst case, you can't sell it, you'd have to take a loss that's just too big. What's your backup plan on refinancing the loan? And maybe the worst case scenario is you decide, I'm just gonna have to give this one back to the lender. If that's the case, that sucks, but you'd rather decide that now as opposed to 6 months from now after you've made 6 more mortgage payments. And I'm never advocating giving a property back to a lender or getting foreclosed on. But it's better for both you and the lender. I lend. I would rather somebody give me the property back without me having to fight them for it. Or if this happens in 6 months, well, that lender is going to be in a worse position because the market may have dropped even more. So sit down with your lender if that's an issue and say, hey, I'm in a bad situation here. What do you prefer I do? Would you rather me just hand you the keys back and we can end this amicably, or you want me to try and sell it and see if you can negotiate with the lender, and maybe you can come to an agreement where the lender says, yeah, let's do this together. Maybe I'll take some of the profit. Maybe it becomes a partnership with the lender, and the lender is willing to take some risk for additional upside. There's another exit strategy that you can do. So all kinds of options there, but you have to explore them and figure out which plan B is your best plan B. Okay. Shannon says, so I'm sitting on cash right now. You mentioned it's not a great time to invest. Should I put that cash anywhere or pay down a primary mortgage? So this is always going to be a personal situation. What I can make some general recommendations, but you need to figure out what's best for you. Generally speaking, I like the idea of paying down a primary mortgage, but you're now getting rid of that cash. If you're going to want or need that cash in the future, let's say you're going to need it as an emergency fund, or maybe you're going to want it to do some investment if some good deals come along. If you use it to pay down the primary mortgage now, you don't have access to that later unless you do like a home equity line of credit. Basically, if you refinance your primary. In typical times, I would say pay down your primary, and you can always take out a HELOC or a refinance later and pull that money out if you need it. But keep in mind, it could get difficult to refinance a primary residence or take out a HELOC against a primary residence these days. I know Chase Bank just announced last week that they're no longer doing primary HELOCs. They basically said they're not taking that risk. So if there's any shot you're going to need that cash or want that cash in 6 or 12 or 18 or 24 months, I would suggest not using it to pay down your primary. If you basically, it's just you have a lot of cash, you have enough for an emergency fund, and then you have a whole bunch left over and you have no plan to use it, no idea what to use it for, then absolutely don't let money sit in cash just to sit in cash. Right now, inflation is at somewhere 2.5%. So every $100 you have sitting in a bank account right now is going to be worth $97 or $98 next year. So don't just let it sit in a bank account because you don't know what else to do with it. But if you have a plan to use it in a year, it might be worth losing that couple percent to inflation to have access to that money for great deals when it comes up. So the question you need to be asking yourself is, what is my opportunity cost? If I don't use it to pay down my primary, what am I going to use it for? Do I have a plan with this money? If the answer is yes, and you're going to put that money to work, then right now I would say put it in a savings account. If you want to take a little bit more risk, you can put it in like a gold ETF or fund. I think gold at this point isn't going to be highly volatile. It might go up a couple percent, might go down a couple percent. I think it's more likely to go up than down, but we don't know. Certainly don't. Nothing I'm saying is investment advice, by the way. So if you want someplace a little different than cash to store it, if you think gold's going to go up, maybe throw it in a gold fund. Worst case, it goes down a couple percent and it's not going to take a big hit. I wouldn't put that money in a stock market unless you know what you're doing, because sure, it could go up, but stock market's volatile right now. It could also drop. So yeah, if you're going to leave it, if you're not going to pay down your primary, either cash or stick it in a gold ETF. Okay. Let's see. Andrew asks, any thoughts on gold or commodities as hedges against inflation? Okay, I'll do a little primer here again. I apologize for anybody that already knows this, but let's talk about what inflation is and what that means. Inflation is basically just an increase in prices. So when your toothpaste tomorrow costs more than it costs today, that's inflation. It's not really, I mean, the technical definition of inflation has to do with the value of a dollar or the value of currency. But the way most of us think about it, if you're going to go take an MBA class, don't use this definition. But the way we think about it is prices go up. And there are lots of reasons prices might go up, supply and demand. If there's less demand, prices are going to go up. If there's less supply, like let's say stuff coming out of China right now is not really being shipped out of China because they're locked down again, prices might go up. When we put too much money into the money supply, so when the government prints all this money, all this money going into the money supply for various reasons I'm not going to go into now, causes prices to go up. So there's this inflation. Inflation at 1.5% to 2.5% is pretty typical, which means prices are going to go up 1 or 2 or 3% every year. That's what's happened for the last 150 years. It sucks. Things get more expensive. But the nice thing is, typically with inflation, wages go up with that. So the amount you're getting paid from your employer is hopefully going up at least as much as inflation. So you're covering that cost. The problem is if we get in a situation where we have very high inflation, and that can happen when there's constrained supply, like you can't get stuff out of China, or our manufacturers are shut down because people aren't working. That causes prices to go up. We also don't have a lot of demand, so that's kind of offsetting the lack of supply. But printing a lot of money can risk high inflation. So what do you do? Let's say we're concerned about inflation getting to 5 or 6 or 10%. We're concerned about our money being devalued tremendously. What do we do to what we call hedge that risk? And by hedge, we mean counteract that risk. There's a couple things we can do. So as Andrew mentioned, gold and precious metals and other commodities are typically a pretty good hedge against inflation, which means if inflation goes up, the price of gold and other precious metals tends to go up because people move their money to something that they feel is safe. And when a lot of people want to buy gold, the price of gold goes up, supply and demand. So yes, gold tends to be a pretty good hedge against inflation. You know what the best hedge against inflation is? Real estate. And there's a couple of reasons for that. Number one, typically with inflation, when the price of stuff goes up, and the price that your wages go up, the price that your companies are paying their employees goes up, well, the price of housing goes up as well, which means rents go up and housing costs go up. Is it linear? Like for every 1% that inflation goes up, housing goes up 1%? Not necessarily, but it's pretty good. So housing tends to be a really good hedge. Gold tends to be a good hedge. Housing tends to be a good hedge. But here's the absolute single best hedge in the world against inflation: leverage or debt. And let me explain to you why. So let's say I work at a job and I make $50,000 a year. Now I go to buy a house, $200,000 house, or I go to take a $250,000 house. I take out a loan for $200,000. Okay. I now have a 30-year loan for $200,000. I'm making $50,000 a year. Quick math. How many years of salary would it take me to pay off that house? 4. Okay. $50,000 a year, ignore taxes. It doesn't matter here. It's about 4 years of salary is going to allow me to pay off my house. Okay. Let's say we have inflation. Let's say we have massive inflation. Let's say everything goes up 10%. So the price of everything goes up 10%. But at the same time, let's say my wages go up 10%. Or let's use a real extreme. This isn't going to happen, or I hope it's not going to happen. But let's say everything doubles in cost. Okay. So now instead of making $50,000 a year, everything costs twice as much, but now I'm making $100,000 a year. How much is that loan that I got on my house? I still owe $200,000. Inflation didn't increase the amount I owe on that loan. I still owe $200,000 on that loan. But now everything's doubled in price. I'm now making $100,000 a year to keep up with that inflation. How many years of salary does it now take to pay off that house? Now it's only 2 years worth of salary. So I went from basically having to pay 4 years worth of salary to pay off that house to, thanks to inflation, not necessarily a good thing, but in this case, a good thing. Thanks to inflation, I can now pay off that house in 2 years. Now, let's say we had massive inflation and everything went up 10 times. Well, now I'm making $500,000 a year. Obviously, that $500,000 is not buying me any more than it was because the price of everything went up 10 times as much. But I can now pay off my loan in about 5 months. 5 months of salary pays off that loan. So if you're really worried about inflation, leverage or debt is the absolute best hedge against inflation, because you're probably going to be making more money along with that inflation, and you can now pay down that debt with less of your salary. So that's something that a lot of people they talk about, but people don't understand. Hopefully that explained it in a way that really helps you understand why debt and leverage is the absolute best hedge against inflation. Now, I am not saying, please don't take that as go out and get as much debt as you can and borrow as much as you can. I am certainly not saying that, because there are plenty of risks that come with leverage. There are plenty of risks that come with debt. So don't take that as me. I was giving you a scenario of why debt can be a great hedge. I'm not recommending anybody necessarily go out and do that. Okay. Don't go do that and go bankrupt and then blame me for telling you to take out ridiculous loans. Okay, let's see. What else do we have? Matthew, you think there's a chance that it's a good idea to get into note investing, or a lot of homeowners that are so should originate their own notes to help save their own positions? Okay, note investing. So first, let me start with, I'm not an expert on note investing. I buy some notes, I originate some notes, I sell some notes, but the note space is pretty complicated. There's lots of niches, and so I don't want to pretend that I'm an expert on notes. But I will tell you that there are a number of people that are experts on notes that are very much looking forward for what could possibly be coming in terms of a downturn, because there will be a lot of opportunity for notes. Typically speaking, notes are going to be discounted from their value. So let's say I sell a house and I take $100,000 note, which means the buyer of the house now owes me $100,000. I can collect on that note until the $100,000 is paid off. But a lot of times I don't really want to collect on that note. I want to sell that note. Hopefully I made money when I sold the house, so I don't have to sell the note for $100,000, even though it's a $100,000 note. Typically, notes, when you sell them, are going to be discounted. If the seller is paying, if he has a good credit score, the buyer, if the buyer is paying, if he has a good credit score, if the note is seasoned, which means that it's been paid for 6 or 12 or 24 months consistently, he hasn't missed any payments, he's a good borrower. These days, that's called a performing note. He hasn't missed any payments, so the note is good. It's being paid every month. Typically, these days, those types of notes are selling for about a 10% discount. So I might be able to sell to you that note for $90,000. You're now getting $100,000 in future payments on that note for $90,000. So that's a decent discount. You're getting a 10% discount. You're not getting all your money right now, and there's time value of money, but you're getting $100,000 in future payments on a $90,000 note. During a downturn, because now this borrower who was paying really well, had a high credit score, he's now a bigger risk. What happens if he loses his job? What happens if he gets his wages cut or his hours cut and he now can't make that payment? There's more risk in him being able to pay that note. So during a downturn, if I'm going to sell this note that's worth $100,000, I may have to sell it for $80,000 or $70,000. You as a note buyer, you can now buy a note that is going to pay $100,000 hopefully over the next 5, 10, 30 years. And you can buy that $100,000 for right now, $80,000 or $70,000. So we see larger discounts in these notes. With these larger discounts become opportunities. Obviously there's more risk, but the bigger the downturn, the bigger the risk, the bigger the drop in discounts. So during 2008, we were seeing notes that were selling at 60, 50, 40%. Then if let's say my borrower stops paying, let's say that it now becomes what's called a non-performing note. He's not paying. I have a couple options. I can evict him, or not evict him, I could foreclose. If I foreclose, well, then I get the property back. But if the property is dropped in value, I may not get as much out of it. But if he stops paying, I may decide the easier option is just to dump that note. I may sell that note for pennies on the dollar. I may sell that note for $5,000. So $100,000 note that I'm selling for $5,000 or $10,000 or $15,000 because the house isn't worth as much. I don't feel like arguing with the borrower or having to go through a foreclosure. So I sell that note for a really cheap price. You might be able to buy that note for $15,000 if you can figure out how to get that borrower to start paying again. Or maybe you go to the borrower and you say, hey, I'll make you a deal. I just bought this note for $15,000. I'll let you pay it off for $20,000. Go take out $20,000 on your credit card. Give it to me. You own the house. And I made a $5,000 profit. So note investing can be very profitable during a downturn because there are a lot of people that have notes that they have to sell at a large discount, either because there's a lot of risk or the borrower stopped paying. So yes, I think that getting into note investing, there's a great opportunity now. Now is a perfect time for the next 6 to 12 months to learn about note investing because it could take you a year to really learn and understand notes. It's not an easy space, but that's the nice thing. Anytime there's this barrier to entry, anytime that it's difficult to learn something, you have a competitive advantage. You don't have to worry about a million people coming in because there are a lot of people out there that are too lazy to go and put in the effort. So if you're willing to go and put in the effort, now is a great time to be learning about notes. You ask, let's see, a lot of homeowners that are sellers should a lot of homeowners that are sellers originate their own notes to help save their own their positions. So if you own your house and you have a lot of equity, I think that's a great strategy. If I were going to sell my personal residence and I had it paid off, I might. And so basically for anybody out there that doesn't understand this, what Matthew's saying is, should I become the bank? So I'm going to sell my property. Let's say I have a $100,000 house. I'm going to sell it. The person can't get a bank loan either because lending's tight or they have bad credit or for whatever reason. I might say to them, okay, put $20,000 down. And because I've had the house paid off, I don't have to pay off a mortgage. I'm going to be the bank on the other $80,000. And you just pay me $1,000 a month for the next 80 months or $500 a month for the next 300 months, whatever the agreement is. But I basically become the bank. And I like that strategy if you can do that, if you have the equity in the house, because that way, if they don't keep paying, you can foreclose, you get your house back and you can go resell again. So I think that's a reasonable strategy as long as you can afford to be the bank and you can hold that note and you don't need that cash right away. It's a good way to get rid of your house at a higher price because typically people that can't get bank loans, they're willing to pay more because they don't have any other options. Okay. What strategy? Okay. So Lapita asked, what strategies can you use to offset capital gains taxes? There aren't a whole lot of strategies to offset capital gains. I don't want to give tax advice. Please don't take this as tax advice, but I will say that there are ways of structuring your company that you can, if you have a certain type of corporation, you can roll those capital gains into other investments and not necessarily have to pay them in the year that you accrued them. So typically speaking, let's say you as a single person, you buy, let's say you buy a stock. You sell that stock a year later and you make $100. That's a capital gain. That's a long-term capital gain if you waited at least a year and a day. And if you did that personally, you now have to pay tax on that capital gain, typically about 15%. Really no good way around it. Let's say you bought that stock in what's called a C corporation. A C corporation is kind of its own entity. It's not you, it's its own person. If you make $100 in capital gains in that C corporation, you can roll that into something else and potentially not necessarily have to pay tax on that $100 because of how you structured that company. There are other downsides to doing this in a C Corp because you now have double taxation. Eventually, you're going to pay taxes on that, and then you're going to pay taxes paying yourself a salary. So I'm not saying do that, but there are ways to do that. The other thing is if your capital gain came from real estate, investment real estate. So let's say you bought an investment, a rental property, and that rental property went up $100,000 over 5 years. You could sell the property, take $100,000 gain and have to pay 15% on that. But the big strategy that people like to use there is what's called a 1031 exchange or a like-kind exchange. Basically, it's a way of taking an investment, pulling out the money, selling the investment, pulling out the money. And as long as you put that money into something that's similar, like another investment property, another rental property, you can defer the gain, which means you don't have to pay taxes on it yet. You've put that money into something else that's a very similar investment, and now you don't have to pay the money until you sell that investment. And if you sell that investment, you can roll it into something else, and you can keep rolling that money out as far into the future as you want, and you only pay tax on the total amount of gain. So you'll add up the gains into the future. You'll pay tax on the total amount of gain when you eventually sell a property and take the money. So if you're not getting any cash advantage from selling the property by doing a 1031 exchange, you can push the taxes off. So that's a 1031. I would say that, again, I'm not here to give tax advice, but if you have an investment that has generated a capital gain, certainly look into a 1031. These days, after the 2018 tax cuts, it used to be that you could roll a 1031 could be done with real estate or basically any investment. So if I bought like a classic car, I could then sell that classic car, and any profit I made, I could use to roll into another classic car. These days, it's only allowed with real estate, real property. You can't use that 1031 exchange with personal property like cars or art or anything else. But you can do it with real estate, and it's just another great benefit of investment real estate. Let's see. Why Not asked, should an attorney, the name is Why Not, should an attorney be involved in making these agreements? I assume we're talking about, he just posted this, so I assume we're talking about 1031 exchanges. Yes, so for 1031 exchanges where you defer the tax by buying another similar asset, we use what are referred to as intermediaries, and these are companies that specialize in helping you sell your current asset and buy another asset. It has to be done in a very specific way. You can't actually take custody of the money that comes from the sale of the asset. So they will hold it in an escrow fund. They'll then shell it out for the new property. So absolutely, if you're looking to do a 1031 exchange, please don't rely on the information I just gave. Talk to a 1031 expert, so an intermediary, a 1031 custodian, and they can tell you all the ins and outs, and they will also help you handle the transaction. It's something that's a little bit, a lot more complicated than the way I just described it. Michael Slusher says tax deferred exchange can work with RE into other assets. There's no question mark there, so I don't know if you're saying this or asking it. As far as I know, 1031 exchanges are only allowed between similar assets, so buying or selling a rental property and buying another rental property. And as of the 2018 tax cuts, 1031 exchanges are not allowed to be used for anything that's not real property related. So two things there is, one, no longer allowed to be used with anything that's not real estate related. And number two, even if there was, it only allows you to roll money from like assets into like assets, similar assets into similar assets. So I couldn't use money that I got from a rental property and roll that into a piece of art because they're not similar enough. So again, talk to a 1031 expert who can give you more details. Let's see. Do a couple more questions because we're getting kind of long here. I don't want to bore you guys. Travis Shirley asked, what's the best way for a new investor to help save up funds for a purchase in 8 to 12 months? Well, again, this is going to be very specific. I'm going to throw out some ideas here. So save money. That's the best way. But let's say you're going to be able to hopefully save some money in the next 8 to 12 months, cutting your expenses, doing a side hustle, starting a business, whatever it is. But let's say that you don't think in the next 8 to 12 months that you can save enough money. What are your other alternatives? There's always other alternatives. So remember, real estate costs money, assets, investments cost money. Doesn't have to be your money. So what are your other options? One, I'm a big fan right now of partnerships. I'm not generally a fan of partnerships, but right now, if you have the right person with the right mentality that complements you well, that you know well, that you trust, that you've worked well together, now's a good time to be doing partnerships, for the main reason that in the next several months or years, there could be a lot of opportunities, and there could be more opportunities than you have the ability to take advantage of. And typically I would say go out and get bank loans, but that could be really difficult. So one of the ways to be able to take advantage of more opportunities over the next several months or years is to partner with people that have money. And the nice thing here is that you can have multiple partners. You don't just need one partner. You can partner on one property with one investor, 5 properties with another investor, 3 properties with another investor. But there are a lot of investors out there who have cash, but either aren't good at finding deals, don't want to spend the time finding deals, don't enjoy finding the deals, whatever. But they have the cash and they want to spend the cash. And you come to them and you say, hey, look, you bring the cash, I'll bring the work, I'll bring the effort, I'll find the deals, I'll underwrite them, and we'll work together. And they aren't necessarily making a loan. They're actually partnering with you. They get a percentage of the equity. I'm a big fan of, I know the next question is going to be how do you break down a partnership like that? How much do they get? How much do you get? Generally speaking, I am a fan of, there's a million ways to do it, but I'm a big fan of whoever brings the money. The money is worth 50% of the deal, and the time and effort and expertise is worth 50% of the deal. So if one person brings 100% of the money and the other person brings 100% of the time, the effort, and the expertise, 50-50. Let's say one person brings 100% of the money, plus they bring 50% of the time, effort, and expertise. Well, then they get 75%. And then the person that brought no money and half of the time, effort, and expertise, they get 25%. So they get half of that 50%. Hopefully that makes sense. That's kind of how I like to break things down. So go out and find partners that have cash. And this is your opportunity now to start building these relationships so that in 6 or 12 or 24 months, when the deals start coming along, you have equity partners. The other thing is find friends, family, colleagues, coworkers, your dentist, your doctor, your lawyer who have money sitting in, let's say, a retirement account, and encourage them, if they're not comfortable putting that money in the stock market, if they're not comfortable putting that money into other things, now may be a great opportunity to say, hey, look, there's going to be some great real estate deals coming down the pipe in a couple months or years. Would you be interested in loaning me that money from your self-directed IRA or your regular IRA and making a safer return? Now's a great time to start educating those people in your life that have retirement funds that may be good investors in the future. It may take them a couple months, it may take them 6 months to get comfortable with what you're describing and how the whole process works, but you now have 6 or 12 months before you're going to be ready to use that money. So now's a great time to start building those relationships, getting them comfortable, answering all their questions. If the money is sitting in an old 401k or a regular IRA, now's a great time to help them get that money into a self-directed IRA. So a self-directed IRA is basically a retirement account that you can use that money for whatever you want, any investment that you want. So a typical IRA or 401k, you can put that money in stocks or bonds. Basically, that's it, or cash. But a self-directed IRA, you can use that money for anything you want. You can invest it in your friend's business. You can invest it in you can go buy physical gold with it. You can loan it out. You can do whatever you want with that money, any type of investment you want within certain guidelines. So encourage people, if they have that money sitting around and they don't know what else to do with it and they want a better return, encourage them to move it into a self-directed IRA, start educating them about how you invest. So in 6 to 12 months, when a deal comes along, you can say, okay, loan me this money or partner with me on this investment out of your self-directed IRA. So 2 great ways to basically be prepared with cash, equity partnerships, and self-directed IRAs moving forward. I'm going to scroll back up towards the top because I probably missed some questions up here. Nathan Cross at 1140, Nikki, if you want to go find that one, said, saw a quote from you shared saying this is going to be the best time to buy into a business. Um, um, I just recently bought into a PM franchise. I was thinking that there will be opportunities in that space. So I don't want to talk directly about PM franchises because I certainly don't know enough about any property management franchise. But I will say that, yes, I think there are going to be some tremendous opportunities in the business space moving forward. I talk a lot about how 2008 to 11, a lot of people look back and say, because of the housing crisis, because of the housing crash, it may have been the best time in history to be getting into real estate investing and buying real estate assets. I think 2020 to 2022 or 23 could be something similar with businesses. Because of this lockdown, there are going to be a whole lot of business owners that go out of business. And in some cases, it's going to be those that just couldn't weather the storm and just can't get back into business because they lost too much money. But then there are going to be other business owners who they were basically on the verge of shutting down their business when all this started. And as a business owner who has shut down businesses in the past, I know what it's like to like just kind of keep things going and say, I know I should be shutting this down, but I just need to give it one last ditch effort. And you keep giving it one last ditch effort. And it's hard to actually pull the trigger and say, now's the time to shut it down. Well, there are going to be a lot of those business owners that after this event, they're just like, well, that's great. This was all the prodding I needed to just shut it down and not restart it. Then there are going to be a whole bunch of people that were nearing retirement and they were running their businesses and they're like, yeah, in a year or two or three, I'm going to sell off this business or I'm going to close the business. I'm going to retire. But now after this event, they're just like, I don't feel like spending the next year or two or three building this business back up just to have to get rid of it in a year or two or three. So there are going to be a lot of people that are looking to get out of their businesses in the next few months. If you look at the data, 90% of businesses, when they shut down, they don't sell off the assets. They don't sell off the business. They just shut it down. That's not necessarily because those businesses aren't profitable. It's not necessarily because they couldn't sell the business. It's because a lot of business owners don't recognize I can sell a business. I'm making money in my business. There are ways to sell it, just like there's ways to sell real estate. I had a business back in 2013, 14, 15. We were making decent money. We had created and were manufacturing a tech education product. And at the end of the day, we're making some money, but we shut the business down. And I think I was just so caught up in so many other things. It never occurred to me that maybe I should focus on selling the business. If somebody would have come along and offered me $50 for the business, that's $50 more than I would have made. In reality, I probably could have sold the business for $20 or $30 or $50,000 based on the income it was generating. But I was just so demotivated at that point. It didn't occur to me, and time passed, and I lost the opportunity. There are a lot of those business owners out there right now that are probably going to shut down what could otherwise be profitable businesses because they just don't see an alternative. They don't think about selling their business. They don't think about the possibility of somebody wanting to build that business up from scratch. If you can find those people, and there are a lot of ways to find those people, just like real estate, there's public marketplaces. There are brokers, just like there are real estate brokers. There are business brokers, just like there's a real estate MLS. There's a business MLS. There are all these opportunities out there, and then you can find these deals off market. Basically, you walk into a business down the street from you, and you start talking to the owner, and you find out that he's tired, he's worn out, he's looking to get out of the business, and you negotiate a deal. Maybe it's a seller financing deal. You don't have to come up with a whole lot of cash. That's the other thing. Businesses are a lot like real estate. You can go get a loan instead of going to Wells Fargo. You actually could go to Wells Fargo and get a business loan, but a lot of times we go to like the Small Business Administration, the SBA. There are ways to get loans. There are ways to partner, just like in real estate. But a great way to buy a business, just like in real estate, is seller financing. So I think over the next couple of years, we're going to have tremendous opportunity in the business space. Go to my Facebook page, follow me on Facebook. I talk all about, because I run, so let me throw out another quick plug. My wife and I are co-hosts of the Bigger Pockets Business Podcast, where we talk with business owners every week. Everything from real small business owners. This week, we actually talked with a woman named Laura Spalding, who just got featured in the, it's funny, we recorded this interview 6 weeks ago, and we've held on to it because of all the coronavirus stuff. But it turns out over the last 6 weeks, Her company, she runs a crime scene cleanup business, national franchise. She has 27 franchisees around the country. Over the last 6 weeks, since the coronavirus thing started, since we recorded this episode, she has become the single biggest company in the country dealing with coronavirus cleanup. Last week or last month, I just read in the Wall Street Journal, she did $33 million in business in cleaning up coronavirus. So just ridiculous growth. This was an opportunity for her. So we talked to her today. Actually, we don't talk anything about coronavirus because we record this pre-coronavirus, but great episode with her today talking about franchising. We've talked to small business owners who buy businesses. We've talked to business brokers. We've talked to people that have started businesses. We've talked to big names. We've talked to Jay Papasan, who runs the Keller Williams book publishing business. So we've talked to some really big names, really small names. If you're interested in business now, go check out the Bigger Pockets Business Podcast. But now is a fantastic time. If you're an entrepreneur, if you're looking to get into business entrepreneurship, now's a great time. Let's see. Maybe one more question. Michael Slusher asked at 11:45. I'll do this one real quick and then do another one. I'm curious how and why the money managers think we're going to bounce back in a few months. Yesterday, the Oak Tree manager said it took 5 to 7 years to get back to normal, but then he said we'll be back by Q3. Don't trust anybody. Everybody has an agenda. I have an agenda. I don't know what my agenda is, but I'm sure I have an agenda somewhere. But if you listen to, it's funny, I hear NAR, so the National Association of Realtors, talking about how now is still a great time to buy a house. And I hear people in the mortgage industry, mortgage professionals, talking about why now is just a great time to be getting a mortgage. And hedge fund managers are talking about now is a great time to be buying into hedge funds. Everybody wants to keep their customers engaged. Everybody wants to keep their customers optimistic because that's good for business. Do they really believe that things are going to get back to normal? Maybe they do. There's certainly people out there, and maybe I'm wrong. Maybe everybody, not everybody, maybe like all of us people who think that things are going to get bad in a few months, we could all be wrong, and maybe they are right. But there's also that chance that they're just trying to stay optimistic because that's good for business over the next few months. So I kind of take everything I hear with a grain of salt. One, people don't know what they're talking about, including me. And two, a lot of people have an agenda because this is their business and they want to keep their customers and their employees and their vendors and everybody around them optimistic about what's going on. So that's part of probably why people are saying, yeah, things are going to be back to normal by Q3. I personally don't think that's the case, but I'm still hearing a lot of optimism from people, especially in the real estate industry, because I think they're just trying to keep their customers and their employees optimistic. And I hope they're right. I don't think they're going to be right, but I certainly hope they're right. Okay, let's see. One more question. Oh, thanks for the nice comments, by the way, everybody. I really appreciate that. Rod, I don't know. Kamsea, I apologize if I pronounced your name wrong, at 1240 asked, hey Jay, as far as the online auctions, this is a good time to invest capital to buy in those online sites. I don't have experience in auctions. Any recommendations? So typically speaking, real estate auction sites are not real auction sites. So when we talk about an auction, we talk about somebody takes a property, it goes to the highest bidder. If you meet a certain reserve, you get the property. In reality, that's not the way most of these auction sites work. In reality, most of these auction sites are just lead generation sites. So banks that have foreclosure properties, for the most part, I guess other people can put properties. Generally, it's foreclosure properties. Go onto these sites, you bid on the property. If you're the high bid, you don't necessarily win the deal. Basically, they take your bid, they hand it to the bank. And the bank says, and they say, this is the highest bid we got on this property. And then the bank can negotiate. And a lot of times the bank will come back and say, nope, we don't accept your bid, or we're going to counter offer. We're going to counter your bid. So you can win a lot of these auctions. I've bought a lot of houses on these sites in the past, but you can win these auctions and still 80% of the houses you're not going to get, because the bank's just going to come back and say, we're not going to accept that bid. It's not high enough. We want a higher bid. So number one is that these aren't real auction sites. These are lead generation sites. If there's a property that you really want, certainly this is one way to go after it. You certainly can get good deals. Like I said, I bought a bunch of properties off these sites. So you certainly can get good deals on these sites. So I'm not saying don't buy, just don't get overly excited just because you win a bid. The other thing I will say is right now, keep in mind, we have a really inefficient real estate market, so we don't know where values are. Banks, in my experience right now, are still not overvaluing, but they're still valuing properties at essentially what they were valuing them at pre-coronavirus. So we're not seeing a lot of discount from what we were seeing a couple months ago. Again, we don't know where prices are headed, but I wouldn't want to be buying right now in most markets at prices from a couple months ago, and that's where most of the prices are. So right now, I wouldn't be buying from these sites, or I'm not buying from these sites. I'm not saying you can't get a fantastic deal. Just don't expect there to be a ton of opportunity here. Maybe you'll dig through and you'll find one gold penny in the. I have no good analogy there, or no good metaphor. Maybe you'll find that needle in a haystack. So yeah, don't not do it, but don't expect that it's going to be a great opportunity. Okay, I need to go get a glass of water. This has been really fun. We're about an hour and 45 in. I hope everybody has gotten some value out of this. I love doing these Q&As, so hopefully I can talk to Bigger Pockets and come back and do more of these. Let me just throw out again, before you leave, go check out the Bigger Pockets bookstore, biggerpockets.com/store. Any audio and digital book right now is $10. So go download your any books that you're interested in, start reading, start learning, start educating yourself, because there's going to be some tremendous opportunity coming up. Potentially, I don't know that for certain, but I think there's going to be some tremendous opportunity coming up. Go check out the Bigger Pockets Wealth magazine. First issue comes out next month. If you buy it now, 20% off if you use the code magazine, again at the biggerpockets.com/store. And that's a physical magazine that will get put in your mailbox. I love getting mail. I actually went out. I could probably get a free copy of this magazine because I'm writing one of the columns in it. But I actually went out. Literally, I went out last week and I bought a copy of it because I just love getting mail. So I actually am getting the physical version, and they'll also send you the PDF version if you order it. And so you can read it anywhere you want, 20% off. Go check out my recession-proof real estate investing book. Again, talks all about the economy, economic cycles, and how we can be increasing profits, minimizing risk during this part of the economic cycle, and actually all other phases of the economic cycle as well. I wrote this book basically as a guide that will work anytime, anywhere. When the market gets better, it'll be just as applicable, just different chapters. And that's available in audio and Kindle. And the physical version of that book is actually going to be out in a few weeks, available for pre-order, I think, on May 1st. So for anybody that wants the physical version of that book, check out all the other awesome books on biggerpockets.com/store. Follow me, J Scott Investor, on Facebook, JScott_123flip on Instagram. If you want to connect with me, J Scott on Bigger Pockets, or j@jscott.com is my email. What else? I mean, that's basically, you can connect with me anywhere except in person because I'm still locked down in my house. That's all I got. So everybody, thank you so much. Please take this opportunity, go out, read, learn, study. This is a great time to just be rounding out your knowledge of how the economy works and how markets work, and putting together a strategy for what you're going to be doing when this whole lockdown thing ends. So everybody out there, stay safe, stay healthy. Thank you for tuning in with me, and I look forward to coming back soon. Thanks, everybody.